Thank you very much, Mr. Chairman. Thanks to all the panelists for being here and for all your work. First, I just want to briefly and publicly again applaud the FDIC decision on capital. I think it's an important first step in the right direction. If I could ask all of the panelists, and I'm sorry if you're repeating yourselves, it seems to me this sort of requirement is important and hopefully effective because it's systemic. It doesn't just depend on sort of regulations and regulators, but it goes to the heart of the stability of an institution without folks having to catch things in real time that may be spiraling in a negative direction. Do all of you fundamentally agree with the premise of higher capital ratios as enunciated by the FDIC proposed rule?
The OCC is a member of the FDIC board, so in that respect, I voted for the FDIC proposal. But also, this is an interagency effort by the OCC and the Fed. And at the same time that I voted at the FDIC, we issued our own as a joint rule, notice of proposed rulemaking on the same supplemental leverage ratio.
And Senator, the Fed simultaneous with the FDIC board meeting voted on the proposed rule as well.
Right.
Senator, I'd underscore this really was a joint collaborative effort among the three agencies, and I think there's really common agreement on this point. And in regard to the strengthening of the leverage ratio, the importance of strengthening the cushion of capital, particularly for the large systemically important institutions that really pose a risk to the financial system, significant disruption to the economy if they get into difficulty. The value of having a stronger cushion of capital to make enable them to better withstand a stressful environment, reduce the likelihood of their failure, and the potential impact on the deposit insurance fund was really a threshold concern for us. And I think there was a general recognition that the 3% minimum leverage requirement that's in Basel III, actually that was an important step because it's the first time there was an international leverage ratio standard established for all the participants in the Basel Accord. So establishing that in the Accord was meaningful and important. I think from our standpoint, the analysis suggests it really was not a strong enough standard, particularly for our largest, most systemic institutions, which is why we came forward with the proposal to strengthen the supplementary leverage ratio requirement.
Great, thank you. And I didn't mean to suggest by the question that it was somehow FDIC only. I understand the nature of all the discussions and decisions and proposed rule. So all of you agree with the basic premise. Then the question, in essence, becomes what's the right level? What's the right number? What's the right percentage? And I continue to be concerned, while this is a very important step, I think, in the right direction, that it's not a significant enough number. It strikes me in particular that you look at smaller banks, community banks, without any regulatory requirement, they're way above this. And seems to me that's interesting and instructive for two reasons. Number one, because the only thing getting them there are market demands and pressures about sustainability and viability. There's not a direct regulatory requirement that gets them that high. Number two, they're not systemically significant like the mega banks we're talking about are. Doesn't it strike you in some sort of basic way that for the mega banks to be way lower than them is the reverse of arguably what it should be?
Senator, I think probably there's a variance in where banks are on leverage ratio as opposed to risk weighting. And of course, you can, this is what a number of us were saying earlier, there's the importance of the complementarity between risk weighting and leverage. each kind of compensates for the way in which the other regulation can be arbitraged. I think what's most important, though, is the area of agreement, which you've been identifying, which is there needs to be more capital in the largest systemically important institutions. From my vantage point, the vulnerability that I see is on the funding side, the short-term funding by the largest institutions. You know, one can differ on what you want as the road into the higher capital requirements. I think I'd rather respond most directly to the vulnerabilities that I see. But again, I think certainly on this side of the table, and from what I've heard on your side of the dais as well, there's a general agreement that we do need to continue the process of pushing up capital levels. They've already been doubled in our largest institutions in just the last few years. Less risk and a doubling of capital, and we need to continue that work over the next several years as well.
And any other response to my observation? And I realize there's a variance in everything, but in general, it's certainly true that community banks are still way above what we're talking about.
Senator, you raise an important point. I think as a general matter, the largest institutions have managed themselves to a lower leverage ratio than the smaller institutions. I think that was part of the impetus, frankly, for our proposal. It's a judgment call on how high and how fast to push it up. The level we proposed is a substantial increase by our estimates. If it had been in effect in the third quarter of last year for these largest institutions, it would have required nearly an additional $90 billion of capital at the bank level and over $60 billion of additional capital at the holding company level. We think it creates rough comparability with the strengthening on the risk-based side in Basel III. In the NPR, we ask the question for public comment, is this the right level? Should it be higher? Should it be lower? We'll certainly in the comment period take into account the input that we receive.
Great. Mr. Chairman, if I could wrap up in 30 seconds. I take all of your comments as encouraging in suggesting that this is an ongoing process. This isn't the final word necessarily or the end of the road, and I certainly want to encourage that. And let me quote the Financial Times from last night as further encouragement of that. They say, quote, U.S. banks believe they will be able to meet the new regulatory requirement on debt levels by shuffling assets between their subsidiaries and using other optimization strategies to reduce the amount of leverage they report. And that no bank said it expected to raise equity to fill an apparent capital shortfall of more than $60 billion across the industry, close quote. So I'm out of time, but I just make that observation. Now, I realize that shifting of assets is not necessarily insignificant or trivial, but it's a significant observation, I think, that they're not raising any capital, and I cite that as further encouragement to continue down this path.
Senator Warren.